really in the fourth quarter is when people got back to business and there were situations that just needed to be addressed with financing. And a lot of those deals closed in the first quarter of this year. But just to give you, one, I think, very relevant stat, we have closed $245 million in the last 2 quarters and are on track to close another 150 or so million this quarter. So our volume is getting right back to pre-COVID levels, and we expect it to surpass that easily next year, given the amount of pent-up demand.
This is the Lodging Leaders Podcast with John Albano
and Judy Maxwell.
Session number 345.
Welcome to the Lodging Leaders Podcast, where top-performing hoteliers and hospitality industry experts share powerful insights and actionable advice to help you grow your portfolio. And now your host, John Albano.
Hey, Lodging Leaders. Thank you so much for tuning in today. You can find the expanded report for this episode at lodgingleaders.com/345. Rosy View of Future. Hotel industry sees unleashing of pent-up investor demand. The coronavirus pandemic in 2020 flipped the fortunes of U.S. hotel investors in mere days as business plunged to historic lows. Shockwaves continue to ripple as owners hang on and build back business. And business is indeed coming back. Industry analysts at the lodging conference in September forecasted a return to 2019 business levels by 2023. Hotels' business performance will surpass pre-pandemic metrics in 2025, mostly because of increased rates. HVS anticipates occupancy will remain just below 2019 levels through 2025, but it forecasts a 7.6% uptick in ADR, which will push RevPAR growth by 7%. The steady rise in revenue is what is attracting well-heeled commercial real estate investors these days, and owners are more willing than ever to make a deal. Episode 345 of Lodging Leaders Podcast explores the state of capital investment in the U.S. hotel industry. Featured are Daniel Lesser, President and CEO of LW Hospitality Advisors in New York City, David Turley, President of Kronheim Hotel Capital in New York City, and Matthew Crosswhy, President of Stonehill Strategic Capital, the lending arm of Peachtree Hotel Group in Atlanta. In addition to our regular program, Lodging Leaders is celebrating the spirit of hospitality with a special series called Happy to Be of Service, Stories of Hospitality Giving Back. The stories are shared as bonus content throughout the holiday season. So stick with us through this episode to hear how one hotelier figured if he can build hotels, he can build schools. And he's changing the futures of thousands of children. In January 2020, as the novel coronavirus was just beginning to make headlines, analysts had downgraded the U.S. hotel industry's projected RevPAR growth. At that time, LW Hospitality Advisors reported the hotel industry was flush with debt products and an enormous amount of equity was chasing deals that are hard to find. Owners were overhauling their assets or refinancing to gain equity for new projects. Nearly 2 years later, there's more money in the hotel investment market now than pre-pandemic, said Daniel Lesser at LW Hospitality Advisors.
There's a tremendous amount of capital. I've been doing this over 40 years. I've never seen as much capital from all parts of the world targeting the U.S. commercial real estate market and specifically hotels. And frankly, I believe that's because it's really been proven over time that on a risk-adjusted basis, hotels clearly provide superior returns to a whole host of other asset classes within commercial real estate and other venues. When we fell off the cliff, there were platforms that needed immediate liquidity. There's been a lot of capital from the very beginning, like the capital only poured in even more because there was this perception that there was going to be tremendous distress in the space, which never really realized, and in part, it didn't realize because of all the capital coming in. So generally speaking, people say right after the pandemic, values were down 20 to 50%, right? Today, the general consensus is that for the most part, we're back to just about parity to 2019. This is, again, generally speaking. That does not mean that there aren't some hotels that are worth way less than pre-pandemic or others that are frankly worth more. The point is that there's been this smart, sophisticated capital that knows and understands the lodging space that stepped up immediately and made some significant bets.
In the third quarter 2021, 2 assets traded at $2 million a key, reports Lesser. Minus these 2 sales, transaction volume for the quarter totaled $4.8 billion, or an average of $261,000 per room. Institutional investors are eager to disperse their cash to acquire assets, and some have lined up rescue capital for hotel businesses in need of a bridge to cover gaps in revenue as commercial lenders rescind pandemic forbearance. In August, Peachtree Hotel Group announced, beginning in June 2020, it had acquired $1 billion in stressed and distressed real estate assets. The investments were made through Stonehill Strategic Capital, Peachtree's private equity lending arm. Matt Crossway, president of Stonehill, explains some of the early moves.
We made our first investment in June 2020. That was a one-off investment. Shortly thereafter, in Q3, we made our first bridge loan. And then at the end of Q3 2020, in September, we closed on our first 2 note portfolios from 2 smaller national banks. The loans were distressed as a result of an event, not necessarily poor underwriting.
Peachtree Hotel Group formed Stonehill Strategic Capital in 2010 to assume mortgages of hotels facing foreclosure amid the real estate collapse that triggered the Great Recession. The intent was to take a first position as the hotel business ramped back up and then sell the asset either back to the owner-operator or to a new buyer. In many cases, these hotels were not experiencing a significant downturn in business and were paying their debt obligations, but commercial lenders were calling the loans as the Federal Deposit Insurance Corporation forced banks to dispose of what is considered to be high-risk debt. During the pandemic deployment of capital, Peachtree Hotel Group has an investment strategy that's similar, but not exactly the same as in the trough of the Great Recession. Crossby offers the comparison between then and now.
During the recession, we were never really taking back the assets. It's a similar strategy, but different, and the motivations that's forcing banks to sell are different. During the Great Recession, we were buying loans. They were at much steeper discounts. Our first phone call was to the borrower. There was sometimes a lot of panic because they saw Peachtree Hotel Group, a hotel company that now owned their loan. Our goal was never to own the real estate. We could quickly value what we felt the real estate was worth, the borrower's commitment to the asset. And our goal was to work with those borrowers, figure out what could they afford to pay, how could we keep the asset and keep them committed to the asset, and also have a friendly exit where they could stay in the deal and keep them motivated and committed to that particular investment. Again, the discounts were much steeper, so there was a lot more play that we had on our side in restructuring those loans. During COVID, what you've seen is some banks are just note sellers, and if they're stressed in the market, they just want to liquidate their hotel exposure or whatever's going to create noise with regulators. And I can't tell you the specific motivation of those banks, but they are note sellers, and they typically go directly to groups that they know how to execute and know the risks of buying loans. Another stressor, you had a lot of M&A activity going into COVID and throughout COVID, where you had a lot of banks that were being acquired, or you had some forced mergers, and a lot of this was legacy loans, even going back to the Great Recession. So this was an opportunity where banks were not necessarily as emotionally attached to the loan or the borrower. They elected to sell a lot of these different loans, different banks that had a lot of hotel concentration, and maybe they had noise that was coming from analysts after their quarterly earnings calls. That was another pressure point that was, causing banks to maybe sell off and reduce their hotel exposure. Even though there was a lot of relief given to banks through the CARES Act, through PPP to bridge owners through the pandemic, banks have different reasons in terms of why they want to move loans and reduce their hotel exposure. That is the general thesis in terms of when we see opportunities, it's generally one of these different reasons. We still have the same playbook, except the loans are written so much better. The underwriting was very strong. A lot of these borrowers have been very committed to these assets, and we've been able to restructure and work with these borrowers to stay in these deals, stay committed to these investments, and hopefully we'll be able to bridge ourselves until we're out of COVID.
So far, Peachtree Hotel Group through Stonehill has acquired more than 100 loans. Nobody likes to have their loans sold, Crossby said. Not even Peachtree, but it's good to have a new lender that understands the hotel business, particularly in the COVID-19 era.
A lot of these banks wanted to be much quieter in their marketing process. And when they did sell, they wanted to sell to groups that were going to be more friendly with their customers. And we've developed that reputation in the market with lenders, and we will pay market value. We just have a different way of working through our loans than maybe some different funds that tend to be more predatory. So banks do want to continue to work with these relationships and work with these borrowers who they do hope will be customers again at some point in time. If they are going to sell during this time versus the Great Recession, it's largely going to be to a note buyer who's going to be a little bit friendlier and understands the circumstances around managing these investments.
Peachtree's $1 billion debt pool targeted mostly portfolios of 5 to 30 loans ranging from $5 million to $150 million. Crossway said the smaller purchases were made to establish a relationship with the banks. Stonehill expects a robust end of this year as banks face more pressure from regulators and in the course of doing normal business.
We're significantly growing our portfolio the more traditional way, which is us providing bridge lending, as well as the more untraditional way of purchasing loans. We think the note trade going into Q4, there will be a lot of pressure, largely from the CARES Act expiring and banks uncertain in terms of how hotel assets are going to be treated once they are not protected under the CARES Act. And they might have to start classifying their loans on their books as TDRs, which is troubled debt restructures. When you have troubled debt restructures for loans that are not performing, you have to then take your deposit that are guaranteed that you typically lend on close to 10 to 1. Those dollars now have to be reserved against loans that are viewed as being impaired. And once you're a TDR, it's tough to get out of becoming a TDR. So that's going to put a lot of pressure on banks. And so we do think there will be a number of loans that are going to trade at the end of this year.
Kronheim Hotel Capital is an advisory firm that helps owners, investors, and developers find financing for projects. In August 2020, David Turley, president of the company, was featured in a Lodging Leaders report on opportunistic investors and the creation of rescue capital funds. Recently, we checked in with Turley for an update on that activity.
When the virus hit, everything obviously stopped dead cold. Travel along with investor demand of all types. The virus sucked the energy out of the room completely, and what transpired over the following few months is that reading from the playbook of previous recessions and capital dislocation events, reading from that playbook, money managers and operators went out into the capital markets and raised an enormous amount of money to try to take advantage of the distressed opportunities that they saw on the horizon.
During the Great Recession, hotel businesses rebounded relatively quickly, but there was very little capital to take advantage of distressed situations. It's different this time around, Turley said, as lodging's recovery is choppy and slow, but the industry is awash with capital.
It's a very different shape of this landscape we find ourselves in than the same time during previous recessions. So investor demand initially trying to figure out what's going on, then seeing the opportunity for distressed investing, and then the distress didn't materialize for a number of reasons.
Kronheim Hotel Capital had few clients in 2020. It began to see a rebound in financing toward the end of the year.
Really in the fourth quarter is when people got back to business and there were situations that just needed to be addressed with financing. I mean, a lot of those deals closed in the first quarter of this year, but just to give you, one, I think, very relevant stat, we have closed $245 million in the last 2 quarters and are on track to close another 150 or so million this quarter. So our volume is getting right back to pre-COVID levels, and we expect it to surpass that easily next year, given the amount of pent-up demand. There's an asset in New York City that we financed for a group that was a very distressed acquisition. It was a union shut down older independent hotel that needed a lot of renovation. That was a heavy lift, but we were able to get that done for a large operator backed by a very large capital source. On the other end of the spectrum, an owner-operator picked up a Hampton Inn from a special servicer who had actually agreed to a discounted payoff. That's fairly unique in this world. But they'd agreed to pay off to a third party, effectively letting the borrower sell to a third party at a level below the total indebtedness. And that was a deal we closed a couple months back in suburban Atlanta. We've also helped clients buy back notes at discounts. But that business is pretty spotty. There's a growing amount of notes that are out there for sale, and those notes are actually achieving very good pricing, trading close to par on the unpaid principal balance, which is difficult for me to get my mind around, but just indicative of where values are and where pricing expectations are for investment opportunities of all kinds.
Although Kronheim shelved its rescue capital idea, there has been some high-profile activity in that area. For example, Accor Capital announced in February that it raised $1 billion in rescue capital for hotels. The commercial real estate lender said its loans would help owners bridge gaps in financing if conventional lenders end the forbearance they've extended throughout the pandemic. In May, Accor injected $250 million into AJ Capital, owner of Graduate Hotels. Meanwhile, Kronheim has stepped in to help owners of distressed assets wrench themselves free of predatory lenders.
In a couple situations, there are large commercial banks that, because the loan is in default and they have decided to move on those assets or restructure them in ways that make it very tough for the borrower. In a couple of other situations, those notes have been sold to predatory folks who are coming after the assets or otherwise enforcing covenants and increasing interest rates.
Turley also is doing a lot of construction financing for projects that were in the works pre-pandemic. The construction pipeline was down 8% in the third quarter of this year compared to a year-ago quarter, reports Lodging Economics. The pipeline remains relatively muted for several reasons, including COVID-19, supply chain disruption, increased construction costs, and rising interest rates. That could be why some large investment firms are paying record high prices for existing assets. Here's Lesser with LW Hospitality Advisors.
Right after COVID, dramatic decline in trades. And then quarter by quarter, it's been increasing quite dramatically. Q3 has been just off the charts, well beyond the previous activity, and it's only getting stronger. And not only that, we're seeing some very high-priced trades. The new record has been set in America with the Ventana sale in California for $2.5 million per room, the most ever paid for a U.S. hotel. And then the Montage in Healdsburg at over $2 million a key. There have only been 6 trades in total ever at $2 million or more in the United States. And 2 of those occurred this year. Quite remarkable. This year, there have been 4 asset sales at $1 million per room. There have only been 37 ever $1 million plus per unit sales. So more than 10% of them have occurred this year. It really speaks volumes about the investor perception going forward here. What's interesting is that the value rebound from the 20 to 50% decline really is being driven more in part by what I call capital velocity versus return of fundamental economics. So it could be a dicey proposition, only time will tell.
Here's Turley again.
There's a lot of capital just betting on the recovery in the future in general, betting on higher inflation, betting on just a full recovery in business as usual. The other kind of factor driving this is the inability to find any yield in other asset classes. So if 10-year treasury is at 1.5%, which is up quite a bit from where it was. The stock market, I think a lot of people feel like that's maxed out or due for a correction. Corporate bonds yields are very, very low. And if you look around real estate, if you invest in multifamily or industrial or self-storage, the yields are very, very low. When you look at lodging, there's proof of concept. You know that people will travel. We saw that over the spring and the summer. There's still the bet on corporate and group travel. All those factors are influencing investors stepping into hotels and paying numbers that really only make sense if you have a very, very rosy view of the future.
That's a wrap on this report. Next up is a bonus episode, which is part of Lodging Leader's special series called Happy to Be of Service, Stories of Hospitality Giving Back. This is session 2 of the series, Tiny Smiling Faces. Hotelier rebuilds schools, children's futures in India. Arun Patel, founder and CEO of Visions Hotels in Corning, New York, tells the prototypical story of an Asian Indian immigrant in America building a successful lodging enterprise over years of hard work and sacrifice. Though Patel has good reasons to be proud of his success, he was shocked into the realization that not all things are equal or fair when he visited his home village of Kuchid in Gujarat, India. What he saw propelled Patel to create a nonprofit called Tiny Smiling Faces that has significantly improved the lives of hundreds of children and families, not only in his village, but for many other communities in West India. We asked Patel to share his story. In his telling, Patel refers to himself and other Asian Indian Americans as NRI, which means non-resident Indian.
I moved from India when I was 16 years old. Studied over here, started a small business with a 20-unit hotel. A typical story of a typical NRI, grown a company from one hotel to another hotel and living a good life. We never went back to India. There was no reason when we were young, growing a family, and never had a reason to go back. About 10 years ago, we decided to go to India with the kids. And while I was in India, I visited my village school. My village is called Kuchid Gam. And when I visited the school, it was in very, very bad shape, horrible condition. I studied in that school my first 2 grades. So I was a little bit upset that my school that I studied was in this bad condition. And we felt guilty that we didn't give back, right? Here we are very successful and this is where our hometown is, and didn't give back anything. So I wanted to do something. And because it was one school, money was not an object. So I told the teachers, the village people, parents of the kids, what do they want to see improvement in the school? And we have a good idea of what needs to be done anyway, but we wanted them to be part of it and gave everything what the teachers wanted. Build new classrooms, build a library, a science lab, build new garden, playgrounds, painted the school, add new bathrooms. And one thing I noticed was the kids in the schools were very malnourished. So a lot of the kids who come to this school, because it's a government school, the standards are considered not high, and the rich people will not send their kids to the government school. So only the people who work in the farm earning between $2 and $5 a day send their kids to the school. And most of them were not educated at all. So for them, the value of education was less. They have financial issues. The government do provide free lunch. When I asked the teachers told me, a lot of my kids asked me when is lunchtime. That touched me a lot. I said, you know what, if there's a kids are hungry, there's no way they're going to be able to study anything. So the first thing we did was we started breakfast program in our school, a nice breakfast, playground in the school. We had 120 kids registered in the school and only 50 was coming before. Within a year, we had that population grow to every child was coming to the school.
Patel financed and directed the renovation of the school to give the teachers everything they asked for and more. He visited Kuchid regularly over 3 years to stay abreast of the building project. Word had spread about the improvements in education, nutrition, and the children's lives. In the 3rd year, principals from other government-funded village schools came to Patel and asked for help.
So that's where a thought came into my mind that we have so many hotels. I had like 26 hotels at Visions Hotels. And I said to myself, if I could do a large number of hotels, maybe I can help a large number of schools at the same time. So I applied to IRS to start a foundation. And actually next year, January 26th will be our 10th year anniversary. And January 26th is India's Republic Day. I feel like I'm very good at identifying a problem, going deeper into why the problem exists, and also looking at how we can solve that problem permanently. So for me, a solution to the kids' problem was not just giving them money or even food. What I wanted to do was bring back the love for the school and the kids and the respect by all the NRIs for their village school. It was important for me to set up a system that people will go back and start visiting their schools and helping themselves. Instead of just giving the money, we wanted to create a system that will encourage others to join. Just like the way I took responsibility of my village school, I would like every NRI to take responsibility of their own village school.
Patel turned to AHOA, which gave him free exhibit space at its regional events and annual conference to promote Tiny Smiling Faces to fellow NRIs. Using his own money at first, Patel promised to match a donor's first $1,000. The money hoteliers raise for their village schools through Tiny Smiling Faces Foundation is tax exempt. Tiny Smiling Faces also contributes 25% of each school's renovation costs. The hotelier community responded. Tiny Smiling Faces has helped improve and support 140 schools so far. It costs $3,000 to $5,000 a year to support a village school through Tiny Smiling Faces. Patel said, though there are a few more village schools in need of support, Tiny Smiling Faces has accomplished what it set out to do a decade ago: improve children's lives by improving their schools. As a result, an entire village is freed from the grip of poverty. Next, Tiny Smiling Faces turn its focus on regional boarding schools and ashrams, where children live because their homes are too far away. The concept of ashrams was created by Mahatma Gandhi in the early 1900s. The ashrams Patel visited were in worse shape than the village schools.
The first ashram I visited, I was almost like, what is this? It's horrible. And kids were studying and sleeping in the same classroom. And these classrooms had roof leaking, walls cracked. It's just nasty. In the same village, everybody is rich, very, very rich, very affluent town. So I'm like, I know that there's something not right here, that this doesn't make any sense. So I announced it openly that we'll support with a 25% cost to rebuilding this whole infrastructure here. And we made a 5-year vision. We wanted to make sure there's a 1 to 8th grade place to stay, 1 to 8th grade classrooms, 9th and 11th grade boys place to stay, girls place to stay, and a classroom. 5 different buildings need to be built. And we phased it out over 5 years. I made a plan. I started to get NRI support. No support first year. I couldn't find an NRI to join me. And then I found a foundation, Shiksha Foundation, who said they will match 75% of the cost. We only had to raise 25% now. But I didn't want to just give that 25%. I wanted the village people to help as much as they can, part of that 25%. So there's a community involvement.
It costs $150,000 to build an ashram. The next year, Patel met with fellow NRIs at the ashrams who vowed to help him raise the money. After the first classroom was constructed, local interest grew. Today, the first ashram is nearly complete, and Tiny Smiling Faces and Shiksha Foundation plan to improve up to 15 others over the next 5 years. We asked Patel where the name Tiny Smiling Faces comes from.
We were taught in my own childhood that you see God in every child. For me personally, I always love to see kids smile. What is more fun than making kids smile? I enjoy it myself. To me, it's the right thing to do.
To learn more or to contribute, visit tinysmilingfaces.org. You can contribute overall, or you can designate that your gift go toward a specific project. Thank you so much for tuning in today. You can find the expanded report for episode 345 at lodgingleaders.com/345. You'll find a news blog, photos, links to more information, and a downloadable transcript of the podcast. You can find the expanded content for this installment of Happy to Be of Service at longlivelodging.com/givingback2. Thanks to Daniel Lesser at LW Hospitality Advisors, Matthew Crossway at Stonehill Strategic Capital, and David Turley at Kronheim Hotel Capital. Thanks to Arun Patel of Visions Hotels and Tiny Smiling Faces. If you are a hotelier or part of a hospitality company giving back through a long-term program, or you know of someone, we'd like to hear from you. You can reach out to us at lodgingleaders.com/contact or call 404-594-4484 and leave a message with your name and phone number. Lodging Leaders Podcast is a production of Long Live Lodging, a media platform for the modern age of hospitality. This episode is reported by Judy Maxwell and produced by me, John Albano. I also composed and performed the music. Anand Patel is our website manager, and Neha Patel is our graphic artist, UX UI designer, and digital marketer. If you enjoyed this episode, don't keep it to yourself. Consider sharing it with your followers. There are links for sharing on every page, which makes it super easy for you to spread the word. If you haven't done so already, subscribe to the podcast at lodgingleaders.com/subscribe. There are links for subscribing wherever you get your podcasts. You can find us on Apple Podcasts, Stitcher, Google Podcasts, SoundCloud, Spotify, Radio.com, iHeartRadio, Pandora, and TuneIn. There is no cost to subscribe. All it means is that you'll automatically be notified when the next episode is released. Got a smart speaker? You can stream Lodging Leaders on your favorite device. Just ask Alexa, Siri, or Google to play the Lodging Leaders podcast. And if you're enjoying this show, we'd love it if you'd take a minute to leave us an honest review on iTunes. Thank you so much for tuning in today. I look forward to seeing you next week. Take care and long live lodging.
Thanks for listening to the Lodging Leaders Podcast at www.lodgingleaders.com.